J.J. Kinahan, TD Ameritrade's Investor Movement Index was up around 2% in November. The S&P, however, was fairly flat. So what drove it?
All right, first of all, the Investors Movement Index, just so people understand who are watching your show today, Greg, is it measures our clients' actual activity. It measures everybody who made at least one trade in a month. So you're taking into account not only stock, but also bonds and options. So volatility is something that does influence it. With all that, for the month, yes, we were fairly flat, but we had a big spike down in the middle of the month, and it was kind of interesting. People used the increased volatility in the market as actually a buying opportunity and came in and bought stocks at that time. So, they were like firemen. When others were running for the fire, they ran into it and bought more things.
And some of the things they were buying were consumer discretionary stocks, things like Nike and Amazon and Starbucks. So were they getting a little jump on their Christmas shopping?
I think they may have. It's very interesting. And, the Amazon versus Walmart type of thing, brick and mortar versus online, a lot of our clients voted for the online there. Nike obviously successful in both realms. And Starbucks, of course, being Starbucks. So they had a little dip during the middle of the month also, so people came in to buy that too.
They also like some of the dividend payers. IBM, AT&T were net buys in November. Why was that, you think?
Well, that's also a contrarian play if you think about it. As we're all expecting this Fed rate raise here in the middle of December, and probabilities from Fed funds being about 79% currently that they will raise rates, you would think that people might back off a little bit from the dividend-paying stocks. But actually, it's still only going to be a quarter point if we go with consensus. We're talking about yields up near 4 or 5%. That makes some sense that's really not going to affect them in the shorter term.
And speaking of the rate rise, Citigroup and Bank of America were net sales, according to the IMX in November. People keep saying that these stocks are going to do better with a rate hike. It hasn't really proved that, but it's turned out that way because those stocks are flat to down this year. So talk about why you think these things were net sales in November.
Well, I think it goes back to the same logic while the other dividend-paying stocks were net buys. I think part of it's already baked in, to be honest with you, Greg. They've already had somewhat of a run. And, these are stocks that have rallied recently, so I think what a lot of our clients are saying is, well, let's take some profits here. We have an opportunity, if rates are going to continue to rise, to get back into those stocks if we want. But A, just in case they don't raise rates, or B, is a quarter point already baked in? Because let's face it, you and I have been talking about rate raises since January now. So, so much of it is in anticipation, and I think a little bit of it is let's just take the profits and see where things lie.
And then finally, Microsoft, Intel, and Yahoo were net sales in November. Kind of brought me back to 2001 with these large cap tech sell-offs. So what happened with these three, you think?
Well, the time machine, but also Microsoft up at a 52-week high. Intel and Yahoo's kind of in a different world, as we both know right now, and I think a little bit maybe a fear of what's going to go on with the future of that company. But Intel and particularly Microsoft have performed well. Back to the same thing. People are, I think, trading the proper way. When things go their way, they're taking some profits. Well, this is still a stock that's widely held at our company, just like Make America we talked about earlier. So it's kind of interesting that folks are using upward moves to take off some risk.
All right. Well, thanks a lot, JJ.
Always a pleasure, Greg. Thanks, buddy.
And thank you for watching The Street.